Good evening. A fundamental shift is underway in the architecture of global finance, one that has unfolded quietly, but with profound implications. A primary architect of the existing system is now recasting its role. The People's Bank of China has reduced its holdings of United States Treasury bonds to their lowest point in over 2 decades. This is not a routine portfolio adjustment. It is a strategic, deliberate recalibration whose consequences will resonate far beyond the bond markets. Simultaneously, an equally significant trend is emerging among the G7 nations. Several of the world's most advanced economies are accelerating their acquisitions of gold and silver. Notably, they are not sourcing these assets through the traditional hubs of London or New York. Instead, they are turning to Chinese trading centres, including Shanghai, where Western institutional demand has surged unexpectedly. What we are witnessing is a quiet but decisive repositioning by central banks and major funds. They are moving away from dollar-denominated securities and toward hard assets that cannot be frozen, controlled, or weaponized in geopolitical disputes. The critical questions are, why is China divesting from US debt? Where is that capital being redirected? And why does the timing of this pivot signal a deeper transformation? This analysis will examine how this rush toward precious metals is sending destabilizing waves through the international financial system. It will explore why G7 nations may be insulating themselves against a future where the dollar's dominance is diminished. We will also investigate the underlying pressures in bond markets, China's long-term restructuring of its national reserves, and the strategic reasoning behind accumulating gold in a high interest rate environment. These moves rarely dominate the daily headlines, yet they are precisely the decisions that redefine long-term economic power and sovereignty. For years, China's strategy was clear. As the world's manufacturing centre, its exports generated vast sums of US dollars. Treasury bonds presented an obvious solution: liquid, secure, and backed by the full faith of the United States government. They provided the safety and stability required for managing the planet's largest foreign exchange reserves. This created a self-reinforcing cycle. Exports generated dollars, which were channeled into treasuries, cementing a pillar of China's, and indeed the world's, economic stability. That pillar is now being deliberately reshaped. The reasons are multifaceted: geopolitical tension, strategic autonomy, and a calculated move to de-risk national wealth. The era of unquestioned reliance on a single financial instrument and a single hegemony is drawing to a close. The global financial order is entering a new chapter, and its outline is only just becoming clear. The evidence now confirms a decisive strategic pivot. The People's Bank of China has methodically reduced its holdings of US Treasury securities through its dollar reserves to their lowest level since the global financial crisis of 2009. The figures are stark. From a peak exceeding $1.3 trillion a decade ago to a current position of approximately $760 billion. This is not a momentary fluctuation. It represents a sustained multi-year retrenchment, a divestment that has notably accelerated since 2022. This calculated withdrawal is driven by converging pressures. Escalating geopolitical friction has introduced profound questions about the long-term reliability and strategic wisdom of anchoring national wealth so heavily to the debt of a geopolitical rival. Concurrently, volatile shifts in US monetary policy and rising interest rates have diminished the relative appeal of treasuries for a holder of China's scale, for whom sovereign risk management is as critical as yield. At its core, this is a move to de-risk. Beijing is expressing deep-seated concern over the sustainability of concentrating such immense reserves in the obligations of a single nation, particularly in an era of persistent global instability. Analysts identify this as a central component of a broader, deliberate campaign of de-dollarization, a slow but unmistakable shift away from reliance on dollar-denominated reserve assets. Consequently, the very architecture of China's foreign reserves is being reconfigured. The strategy is moving from accumulation to diversification. The most telling signal of this new direction is the relentless month-on-month accumulation of gold by the central bank. This build-up is far from incidental. It is a direct and purposeful recalibration of how the state intends to safeguard its national wealth. Gold provides a strategic hedge, a sovereign asset with no counterparty risk. immune to freezing orders or political sanction. As the international financial system fragments and geopolitical fault lines deepen, the appeal of this neutral, tangible asset becomes irresistible. It offers a layer of financial security that dollar-based instruments cannot. This gold acquisition is not an isolated tactic. It is perfectly aligned with a comprehensive strategic objective: to reshape the reserve structure by systematically reducing dependence on the US dollar and to bolster the international role of the renminbi. It is a move to spread risk across asset classes and jurisdictions, thereby insulating the Chinese economy from the monetary policies and political decisions of any single foreign power. In essence, this is a clear declaration of financial sovereignty. By converting paper debt into tangible metal, China is pursuing a more balanced, independent, and secure position within the global financial order. China's strategic retreat from US debt has sent a palpable ripple of unease through global financial institutions and sovereign wealth funds, when the world's second-largest economy executes a deliberate pivot away from the dollar. It is an event that commands the immediate attention of finance ministries and trading desks from Tokyo to Frankfurt. Within the G7, there is a growing pointed concern. What is the long-term stability of the dollar if its largest traditional buyers are steadily diversifying? This apprehension has been sharply intensified by the current geopolitical climate, where every financial decision is scrutinized through the lens of strategic rivalry. Given the sheer scale of China's reserves and its profound influence on global trade, even minor adjustments in Beijing's portfolio can trigger significant market anxiety. This uncertainty is now actively redirecting capital. Investors, both private and institutional, are seeking safer harbours, leading to a pronounced resurgence in demand for gold and silver. Crucially, this demand is increasingly being met through alternative channels. The rising trading volumes on exchanges like Shanghai's demonstrate a pivot in physical metal flows, providing nations and funds with a strategic alternative to the traditional Western hubs of London and New York. This is not merely a matter of preference, it is a deliberate expansion of optionality in how reserves are secured. These movements signify far more than short-term market hedging. They reveal a fundamental reassessment of national financial security. Governments are now actively exploring strategies that reduce over-reliance on any single currency or financial ecosystem, deliberately increasing their holdings of tangible hard assets. The direct market consequence is clear. When a buyer of China's magnitude steps back from US debt, the mechanics of supply and demand dictate that the US Treasury must offer higher yields to attract replacement capital. These higher yields, in turn, increase borrowing costs across the board, from government spending to mortgages and business investment. In an era of already record high debt, such pressure can magnify stress throughout the entire financial system. For decades, the dollar's role as the world's premier reserve currency was considered an immutable fact of the global order. That assumption is now being openly questioned. As nations methodically spread their reserves across a basket of currencies and asset classes, the dollar's dominance is no longer a given. This erosion is gradual, but the direction of travel is unmistakable, towards a desire for greater balance and reduced vulnerability. In this recalibrating landscape, gold and silver are undergoing a strategic rehabilitation. No longer viewed as archaic relics, they are increasingly seen as essential, non-political counterweights, assets free from government decrees or default risk, which preserve value during periods of economic or political strain. For nations navigating volatile exchange rates and seeking sovereignty over their reserves, their relevance has never been clearer. But this financial rebalancing is not driven by economics alone. A profound geopolitical calculation is at work. There is now a heightened awareness, underscored by recent global events, that assets held within a foreign jurisdiction can be frozen or seized outright during times of conflict or diplomatic rupture. Consequently, sovereign states are actively seeking assets that exist beyond the reach of external political influence. This is where the strategic value of precious metals, diversified currency baskets, and non-dollar instruments becomes undeniable. They offer a measure of sovereign insulation, a means for nations to reduce their vulnerability to the policy shifts and political decisions of other powers. China's recent actions must be viewed through this lens. This is not a tactical market reaction. It is the execution of a clear, long-term strategic doctrine. By divesting from US debt and accumulating gold, Beijing is sending an unambiguous signal. It is prioritizing inviolable security and strategic independence above financial convenience. It is a deliberate shift toward assets that are, by their very nature, resistant to external control or coercion. A definitive bet on stability in an increasingly fractured world. The logical endpoint of this trend, should it continue, is a fundamental transformation of the international financial architecture. We may be observing the early formative stages of a new order, one characterized by distributed trust, diffused power, and the end of the single currency hegemony the world has known for generations. The pressing question for policymakers and observers is no longer if this change is occurring, but at what pace it will accelerate, and crucially, which nations are best prepared to navigate the transition. The implications are vast. It demands consideration from investors assessing long-term risk, from governments formulating reserve policy, and from citizens who will ultimately feel the effects in their markets and their cost of living. When major economies quietly reposition their foundational wealth, they are not merely adjusting a balance sheet. They are laying the groundwork for the next era of global finance.